Dave Ramsey and Garrett Gunderson have two extremely different methods for wealth building, right? They are almost completely opposite each other. I remember how confused I've been in the past by hearing one financial guru say you need to invest like this and another financial guru saying something completely opposite that. It can be really, really confusing. By applying the best from each method, however, and using it to suit your own personality, your situation, and your lifestyle desires, you can seriously increase your ability to build wealth. So you take from each of the different strategies what works for you. It's not all or none. Hi, I'm Camille Gaines. Welcome to Retire Certain. This channel is all about helping people maximize their skills, their passions, and their savings to create diversified income streams while building wealth so they can enjoy life. Now, back to Garrett Gunderson versus Dave Ramsey. All right, the very first point I want to talk about with these guys and the differences, I'm going to point out a number of differences in their investing methods. The first one is cash flow investing. Garrett Gunderson is all about being self-employed and cash flow investing. Cash flow investing is just investing in a way that's primarily focused on generating income from your assets. Real estate would be a good example of that. Real estate rentals, for example. He also encourages using your skills in your own small business. Dave Ramsey, on the other hand, is all about working really more for an employer and lowering your expenses as much as possible, saving as much as you can for decades, and allowing your stock and bond investments to grow and compound over time. So Garrett, income focused, and Dave, more save and compound wealth slowly focused. People my age, of course, don't have decades to save and compound wealth from passive investing before they retire, and hence this was part of the inspiration that drove me to create my website at retirecertain.com. Both methods, though, both Dave and Garrett's methods often work well when you're under sort of 45-ish, depending on when you want to retire and how much money you want to have. It really just depends on your situation and your life goals to direct you to what strategy and what methodology works best for you. The second area where these two financial gurus differ is in mindset. Garrett's about thinking big and way outside the box. Dave is more about sticking to the plan, adhering to a plan that has worked in the past based on data to provide investors to live comfortably in retirement, especially if they plan to cut their expenses. Dave has a lot of focus on cutting back, while Garrett has a lot of focus on living how you want. The third area where these guys differ is in lifestyle expenses. Speaking of which, Garrett is all about living how you want to live and using financial solutions and strategies to pay for it. Dave is more about cutting costs and budgeting so you can save more money. The fourth area where these guys really differ is in taxes. Taxes are the largest expense for many investors. Garrett's focus is on alternative wealth building and other strategies to lower taxes while building wealth. This is what the wealthy do. Examples are real estate and small business ownership. When handled correctly, these strategies provide legitimate tax write-offs. Examples are depreciation on buildings and small business expenses. On the other hand, Dave Ramsey promotes the use of more traditional tax reduction strategies. Methods like investing in IRAs, whether that's a Roth or traditional IRA, and retirement plans like 401ks. Been there and done that. Both of these methods, and I still do. And both methods have pros and cons, but both methods can be used by smart investors. In my humble opinion, it's not either or. It's combining the two methods to build wealth. The fifth area where these two financial gurus differ is with regard to risk. Both methods have risk, though. Let's be real. Garrett's method for risk is from uninformed investors possibly buying new real estate near the end of long-term increases in the value of real estate so that they're buying in at market highs in the real estate market, for example. Or, common other risk may come from a failed small business, because we all know that small business failures are high. Fortunately, a lot of small businesses now are online and the capital required to start them is minimal, especially for really small operators like we have. And another risk that is involved with Garrett's method that's, potentially could happen for someone uninformed is over leveraging. They take on too much leverage in trying to buy real estate, for example. Dave's method has the risk from investors loading up on stocks near the end of a long bull market when stocks are overvalued, only to experience a bear market just before they retire. When you're 35, you have time to ride out the stock market cycles. No big deal, right? But when you're 60 and about to retire, a nasty bear market can be a game changer, as many people saw in the 2000s. Also, long-term bonds drop in value when interest rates rise. So it's a risk for bond investors who own diversified portfolios in both stocks and bonds. The sixth difference is in regard to what wealthy people do. Wealthy people can do either method, really. Many people graduate from the more passive Dave method to a combination of the Dave and Garrett method, or to Garrett's method, after they've built wealth over the years using Dave's work, save, invest, and compound method initially to get that way. And then it's like, okay, I've got some money. Now what can I do that's beyond just investing in stocks and bonds, especially funds? The very wealthy, like Richard Branson and Sam Walton, obviously got that way from small business and not from passive investing in mutual funds, as Dave promotes. Warren Buffett did not get wealthy from passive investing in mutual funds. He bought in undervalued companies and he became involved in the businesses, much like an entrepreneur would do, to help them increase their profits. You can watch my video for more on how Warren Buffett really became wealthy. The reality is that Dave Ramsey got wealthy from small business, teaching people how to pay off debt and how to invest in stocks and bonds, not from mutual fund investing. But there's certainly nothing wrong with the method that Dave Ramsey used to get wealthy. Let's just be real and realize that most of his wealth didn't come from passive mutual fund investing. The seventh difference in methods between Garrett and Dave is regarding time, how much time it takes. Garrett's method allows for much more freedom and flexibility for when and how you work and how you build wealth. As someone who's an online business owner, real estate investor, and lover of stock dividends, I can promise you that it takes a lot of time to manage more alternative income streams. But I enjoy investing. And being an entrepreneur, otherwise, I'm spending my time, if I'm not doing entrepreneurial things, I should say, I'm spending my time out, shopping for clearance sales or doing other things that maybe aren't as high value, that aren't more focused and productive. Dave's method, on the other hand, is based on, working full-time in general. There's no time flexibility in most jobs, and there's really very little upside potential, which leads me to the next difference in Dave and Garrett's methods, and that's the ability to get seriously wealthy. I've already touched on this just a little bit. Garrett's method is focused on getting seriously wealthy. The huge majority of people don't do this for various reasons. I believe it's usually around mindset, but the method to get seriously wealthy is definitely there with, income streams and alternative types of investments. Dave's method, on the other hand, it's based on eventually securing a comfortable retirement and living frugal in the decades preceding retirement. I will say that the very wealthy, again, didn't get that way from buying mutual funds and allocating, percentages among stocks and bonds. Can you accumulate a multi-million dollar, portfolio from investing in mutual funds? Absolutely. If you make enough money and you save enough money and you invest it long enough. Just to offset the comments ahead of time, I also want to mention that I almost always prefer lower cost methods over most mutual funds. I usually get a lot of comments about, I use ETFs or whatever it is that costs less than certainly most actively managed mutual funds. And then the next area where Dave and Garrett differ is regarding debt. This is a really big one for these two guys. Garrett encourages good debt outright. Dave is against debt based on his own experience becoming way over leveraged several decades ago when real estate prices were overvalued and he bought a lot of real estate on debt. There are merits to each method. Again, I bought my first stock mutual fund when I was just 22 years old, and my first real estate, which became a rental, when I was 25 years old. Decades later, we created multiple income streams after we saw this was a better solution for us after stumbling into early retirement. The best method for you really depends on your age, your net worth, and your desired lifestyle. It depends on how much time you want to spend toward building wealth, managing your wealth, creating income streams. Some people are just not that interested in it and don't really care, and that's great. There's no right or wrong in any of this. It's just two different methods. Tell me if you like the Dave Ramsey method or the Garrett Gunderson method better and why in the comment section below. And to see more about how Warren Buffett really invests, watch this next. Remember, build wealth, create income streams, and enjoy life.